Welcome back to the channel, financial enthusiasts. Today, we're diving deep into the tech titans of the financial world. Buckle up as we explore the financial metrics and market potential of four industry giants: Salesforce, Intuit, Meta Platforms, and Microsoft. We're breaking down the key numbers, comparing their performance, and giving you insights to help you understand which of these powerhouses is dominating the game and why. Whether you're an investor or just fascinated by the financials, this analysis will keep you glued to your screen. Let's get started. Let's begin with one of the most widely used valuation metrics, the price-to-earnings ratio. This tells us how much investors are willing to pay today for a dollar of earnings from the past year. A high P/E ratio usually indicates that investors expect high growth rates in the future. Among our contenders, Intuit leads with a P/E ratio of 36.46, indicating strong investor confidence in its future growth. Microsoft is close behind with a P/E of 35.29, followed by Salesforce at 29.46. Meta Platforms is the cheapest in this regard, with a P/E ratio of 26.95. This suggests that investors are paying a premium for Intuit and Microsoft, possibly due to their consistent revenue streams and innovation in the tech space. On the flip side, Meta's lower P/E might reflect concerns over its recent strategic shifts and heavy investment in the metaverse. Looking at the 5-year average P/E, Intuit again takes the crown with an average of 42.00, which shows that it has consistently commanded a high valuation. Salesforce comes next at 44.67, followed by Microsoft at 33.53, and Meta at 25.27. Meta's lower average P suggests that it has been priced more conservatively over the years, possibly due to its volatile earnings and public scrutiny. When we turn to the forward P ratio, which gives us a peek into how the market views these companies' future earnings, all four companies show slightly lower ratios compared to their TTM P/E. Salesforce drops to 24.03, Intuit to 28.04, Meta to 21.88, and Microsoft to 27.07. This reduction across the board suggests that while these companies are still considered growth stories, the market is pricing in slightly more cautious expectations for their earnings growth. Continuing with the price-to-earnings to growth ratio that adjusts the P/E ratio by factoring in growth rates, giving us a more nuanced view. Here, Meta stands out with a PG of 1.98, indicating that its growth prospects are reasonably priced. Salesforce follows with a PG of 1.81, showing a good balance between growth and valuation. Microsoft and Intuit have PGs of 2.42 and 2.57, respectively, which might suggest that while they are expected to grow, investors are paying a premium for this growth. A lower PG generally indicates a more attractive investment when considering both growth and valuation. Insider ownership is a key indicator of the confidence that those running the company have in its future. Meta Platforms leads with a staggering 13.8% insider ownership, which is a strong signal that the company's insiders have a significant stake in its success. Salesforce and Intuit also have solid insider ownership, at 2.61% and 2.54% respectively, while Microsoft trails with 1.47%. The high insider ownership at Meta suggests that the company's executives and founders are heavily invested in the company's long-term vision, which could be reassuring to investors. When it comes to profitability, Microsoft shines across all key metrics. With a return on equity of 37.13%, return on assets of 19.07%, and return on invested capital of 30.37%, it's clear that Microsoft is highly efficient at generating profits from its equity, assets, and invested capital. Meta follows with an ROE of 35.37%, ROA of 23.54%, and ROIC of 32.28%, demonstrating its robust profitability, despite its heavy investments in new ventures like the metaverse. Intuit also performs well, with an ROE of 16.6%, ROA of 9.89%, and ROIC of 15.17%, reflecting its stable and profitable business model in the financial software space. Salesforce, while profitable, lags behind with an ROE of 9.34%, ROA of 5.77%, and ROIC of 9.79%. This could indicate that while Salesforce is growing, it might not be as efficient in converting its resources into profits compared to its peers. The evolution of shares outstanding can significantly impact shareholder value. An increase in shares can dilute existing ownership, while a decrease often indicates share buybacks, which can enhance value. Salesforce has been increasing its shares at a compound annual growth rate of 5.18%, which could suggest that it is raising capital to fuel its growth. Microsoft, on the other hand, has been reducing its share count by 1.1% annually, indicating a focus on returning value to shareholders through buybacks. Intuit and Meta have seen flat evolution in their share count, suggesting stability in their capital structures. Now let's talk about earnings per share or EPS, which is a critical metric that represents the portion of a company's profit allocated to each outstanding share. Meta leads the pack with a robust EPS of $19.59, followed by Intuit at $17, Microsoft at $11.81, and Salesforce at $8.96. However, it's important to consider future growth as well. Salesforce is expected to see the highest EPS growth over the next 5 years, with a compound annual growth rate of 16.24%, signaling strong future earnings potential. Microsoft and Intuit are also expected to grow their EPS by 14.6% and 14.2% annually, respectively. Meta, despite leading in current EPS, has a more moderate expected growth rate of 13.6% in the next 5 years. Over the last decade, Salesforce has shown the most impressive EPS growth with a CAGR of 37.2%, highlighting its rapid expansion and scaling. Meta follows with a 30.63% CAGR, showcasing its dominance in the digital advertising space. Intuit and Microsoft have also seen strong EPS growth, with CAGRs of 23.25% and 18.15% respectively, reflecting their successful adaptation and growth in their respective markets. Free cash flow per share is a vital indicator of a company's ability to generate cash relative to its shares. Salesforce leads in free cash flow per share growth with a CAGR of 28.56% over the last decade, followed closely by Meta at 28.02%. This is a strong indicator of their ability to generate cash, which can be reinvested into the business or returned to shareholders. Intuit and Microsoft have also demonstrated solid free cash flow growth, with CAGRs of 14.97% and 14.71%, respectively, reflecting their ability to generate stable and growing cash flows. For dividend-focused investors, Microsoft offers the highest yield at 0.82% with quarterly payments of 85 cents, coupled with a solid 10.35% dividend growth rate over the last decade and a free cash flow payout ratio below 40%. Intuit follows with a yield of 0.67% and quarterly payments of $1.04, boasting an impressive 16.83% dividend growth rate. Despite lower initial yield, if it can maintain a similar growth, will catch Microsoft in only 5 years. Salesforce and Meta have only recently started paying dividends, with Salesforce offering a 0.61% yield and quarterly payments of 40 cents, and Meta offering a 0.38% yield with payments of 50 cents. This marks a significant shift for these companies as they transition from high-growth strategies to returning value to shareholders. Both started its dividend payments with a free cash flow payout ratio close to 10%, so can indicate a 15% to 20% growth rate in their respective dividends. Operating margin and profit margin give us insights into a company's efficiency and profitability. Microsoft again leads with an impressive operating margin of 44.64% and a profit margin of 35.96%. Meta is not far behind with a 40.49% operating margin and a 34.34% profit margin, showcasing its highly profitable digital advertising business. Intuit's operating margin of 23.66% and profit margin of 18.19% reflect its solid business model and financial software. Salesforce, while still profitable, lags with an operating margin of 18.45% and a profit margin of 15.3%, suggesting it has room for improvement in its cost management. When we look at the evolution of revenue and earnings over the last 8 years, all 4 companies show very positive trends. However, this growth has been reflected differently in their market prices. Salesforce, despite its strong financial performance, has underperformed the S&P 500 ETF, VOO, in total returns over the last 5 years. In contrast, Intuit, Meta, and Microsoft have all outperformed the VOO, reflecting investor confidence and their strong market positions. Additionally, Microsoft is the only one who outperforms the tech sector ETF total return during the last 5 years. Debt ratios provide insights into a company's financial leverage. Microsoft and Meta are the least leveraged with debt/EBITDA ratios of 0.50 and 0.51, respectively, indicating very conservative use of debt. Their debt/free cash flow ratios are also low, at 0.91 for Microsoft and 0.75 for Meta, suggesting strong cash flow relative to their debt levels. Salesforce and Intuit have slightly higher debt/EBITDA ratios of 1.24 and 1.42, respectively, indicating more leverage, but still within manageable levels. Finally, let's talk about market caps and last 52 weeks price returns. Microsoft leads with a whopping $3.10 trillion market cap, followed by Meta at $1.34 trillion, Salesforce at $255.82 billion, and Intuit at $173.28 billion. All 4 companies have obtained a spectacular price return over the last 52 weeks, which is a price return over 20%. Now let's talk about the moment that all you are waiting for, the crystal ball and analyst expectations. Analysts predict varying price targets for the next 12 months. Salesforce's price target is $300.37, representing an upside of 13.78% from its current price of $264. My fair value, however, is $262.57, suggesting current fair valuation and a good entry point to start investing into this company. On the other hand, Intuit has a price target of $708.41, representing an upside of 14.29% from the current $619.85. My fair value, however, is far from the current one, around $574.66, indicating potential overvaluation. Meta's price target is $568.65, representing an upside of 7.7% from the current $528. My fair value is a little bit lower than this current price at around $485.40, also suggesting an overvaluation. Finally, Microsoft's price target is $499.49, representing an upside of 19.84% from the current $416.79, and my fair value is $383.01, indicating current overvaluation. In conclusion, each of these tech giants has its strengths. Microsoft stands out for its profitability and cash flow, Meta for its insider ownership and growth potential, Intuit for its solid dividends and growth, and Salesforce for its rapid EPS and free cash flow growth. Your choice depends on what you value most in a company: growth, profitability, or market leadership. So, which one will you invest in? Let us know in the comments below. If you found this breakdown insightful, don't forget to hit that like button, subscribe, and ring the bell for more in-depth financial analysis. Until next time, happy investing!